Hello, everyone, and welcome to the show. I'm your host, Hiran Amin. It appears Canadian investors are shying away from risk as we grapple with a bear market in early 2023. Some have been piling money into lower risk assets in the hopes of protecting their portfolios from market volatility. In fact, the $5.9 billion added into fixed income ETFs in December of 2022 was the largest monthly influx on record, according to data from the National Bank. But consider that there tends to be a price for that perceived safety, if history is any guide. Here's a look at the hypothetical growth of $100,000 if it were invested in the S&P 500 index over a 20-year period from 2002 to 2021. An investor who stayed invested through the ups and downs of the market would have more than $600,000 at an average annual return of 9.5%. But now, let's say they instead try to jump in and out of the market in an attempt to avoid the declines. If they miss the best 5 days in the market during the 20 years, they would end up with less than $400,000 at an average annual return of about 7%. And if they missed out on the 25 best days, they would have just $134,000 at an average annual return of less than 1.5%. So, what can an investor do if they want to stay invested in equities, but just can't stomach the wild swings that they bring? Well, that's where so called low volatility funds might be an option. They seek to deliver smoother performance over time by investing in less volatile stocks. So let's find out more about how they work. Joining us is Nirujan Kanagasingam, Vice President and Head of ETF Strategy at CI Global Asset Management. Nirujan, thanks for taking the time to swing by. Can you share a little bit about what you do in your role at CI?
Sure, here, and thank you for having me here today. So my name is Nirujan Kanagasingam. I head up ETF strategy at CI Global Asset Management. So CI is the fifth largest ETF provider in Canada. So offering really a full gamut of ETF solutions from low-cost passive products to factor-based solutions actively managed ETFs. My role at CI Global Asset Management is to really help grow our ETF footprint in Canada and primarily working through our various partners, distribution team to ultimately help investors learn more about ETF, so ETF adoption, ETF education, and really help with incorporating ETFs into their portfolio.
All right, brilliant. We've definitely got the right guy to be questioning our topic here today. So let's dig into low volatility funds and what they're all about. I want to start with a bit of context around risk and return for those who may not be familiar. What does it mean when an investment has high or low volatility, and how does it relate to its riskiness?
Sure, Aaron. It's a great question. So oftentimes risk and volatility are terms that are used interchangeably. And while there is a lot of commonality and similarity, it's not the exact same. First and foremost, risk in investing can mean different things to different people. Risk in finance is simply the probability of losing some or a portion of your investment. But there's also other forms of risk as well, especially in this current inflationary environment. One type of risk that exists is getting inadequate return on your investment and potentially not being able to meet the rate of inflation into this market environment. So that's the shortfall risk that exists in this current environment. Volatility, on the other hand, is a measure of how much an asset's value changes over time. A stock that has high variability in return month over month would be considered high volatility and in turn create less predictability in terms of return expectations. So investors that want to have more predictable return expectations, less variance in their return month over month, would consider low volatility stocks. Conversely, investors that can stomach the higher volatility and the corresponding price swings would consider more higher volatility stocks. Ultimately, it comes down to investors' risk appetite.
All right, thanks. And I think that's often a misinterpreted term. We often associated high volatility with high riskiness, but thanks for clarifying that. So let's get into actually low volatility funds themselves. So we talked about stocks, investing in low volatility stocks. So what exactly or what type of stocks will these low volatility funds typically hold?
Sure. So as the name suggests, low volatility investing is essentially the concept of investing in less volatile companies within your portfolio and avoiding the so-called higher volatility companies in your portfolio. And it's really designed to help investors experience less volatility in their portfolio and provide a smoother ride is the primary objective. For example, some strategies out there will screen for companies that have exhibited the lowest beta to the market, which is a relative risk measure. So it's comparing risk relative to the broad market like the S&P 500 or a TSX composite. Some strategies will look at measures such as standard deviation, which is more of a traditional risk measure that considers the variance of return of a single stock. The type of risk measure that you use to quantify volatility can have material difference in terms of what companies you choose in your portfolio or hold within your portfolio. But ultimately, the goal of these strategies is to construct a portfolio of companies that exhibit less volatility than the broader market. Now, by screening for these companies using the various risk measures, what you end up with is a portfolio of companies, and typically you end up in certain defensive sectors that have historically exhibited less volatility than the broader market. These have been sectors such as the healthcare sectors, the utility sectors, and consumer staples. So low volatility strategies tend to have a bias towards these defensive sectors. And I say the word generally because the objective of these low vol strategies is not to explicitly invest in these sectors. It's a byproduct of the screening for volatility. And these sectors have historically been the most resilient from a historical volatility perspective. And when you take a look at the sectors like healthcare or utilities, it makes sense, right? The demand for these sectors tend to be very inelastic. So when market environment changes, demands for these products don't tend to change, which leads to less price fluctuations for these companies. And when you screen based on low volatility, these companies tend to screen well during that process.
Yeah, and I like you put it that way because usually we have to keep the lights and the heat on. So regardless of what's happening, around the economy and the markets there, which actually leads me to the next question. You said there's a bias towards this defensive sector. So let's talk about some of the potential. Let's talk about some of the benefits or advantages first of the low volatility funds that you have.
As we all know, markets are extremely difficult to time, especially in periods of elevated market volatility. It might be easy to go to cash, but missing out on those meaningful return days can potentially risk not meeting your investment goals. While being fully invested during certain market environments and periods of market volatility could mean significant capital losses. This is where low volatility strategies can allow investors to stay invested in equity markets during periods of high market volatility while taking some risk off the table and really provide investors a less stressful entry points into the equity market. Another benefit of low volatility strategies is the long-term empirical results. When you take a look at historical results of low volatility strategies from an absolute return perspective, from a risk mitigation perspective, from a drawdown perspective, these strategies have historically added alpha to investors' portfolio. Now, this might sound a little bit counterintuitive because in finance, we're taught that higher risk equals higher return, but in reality, the results have shown that this hasn't been the case. And this is where low volatility funds, by seeking to limit the number of drawdowns and the severity of the declines in the market, allows for there to be less ground to make up over time. When you have a 50% decline in the market, you require a 100% increase just to break even and recover that loss. So by losing less in periods of high market volatility, the strategy is able to protect capital, which can compound higher. And there's also some other additional benefits of low vol investing as well. If you take a look at low volatility strategies historically, they have also added a nice income component to your portfolio. This again goes back to the sector biases that these strategies tend to invest in. So by screening for low volatility companies, you often end up investing in sectors such as the utility sectors, the REIT sectors, sectors that generally pay a higher dividend yield. And this has been an additional component or benefit of low volatility strategies. Again, I want to stress that it's not the objective of these strategies to provide a higher income. It's just been a byproduct of low volatility strategies. And I guess the last point on just the benefit of low volatility strategies is we all know that we all invest in equity markets for long-term capital growth. But when equity markets fall, as they do, the timing of the fall can have a major impact on your investment balance. And what we have seen is that in periods of high volatility, the correlation of most asset classes tend to go to 1, meaning that many asset classes start behaving dissimilarly when volatility rises. This is where low volatility strategies are really designed to help smooth the ride for investors and really give equity investors the opportunity to earn meaningful returns while reducing the downside risk of the investment.
Now, let's actually turn this on the head. So we talked about the benefit. Now, we know that no investment approach is, flawless. So what are some of the potential risks of investing in low volatility funds to consider then?
Like all factors and various asset classes you can invest in, the performance of low volatility strategies are cyclical. So low volatility strategies are designed to dampen movements to both the upside and the downside, compared to traditional funds, like I said, the S&P 500 tracking funds. Therefore, in periods of extended up markets or strong growth markets, bull markets, what have you, low volatility strategies can potentially miss out on significant gains. So the objective of these strategies is not to outperform on the upside, is to really mitigate on the downside. When you invest in low volatility strategies, you can potentially lead to certain concentration in certain gig sectors, like I mentioned, the utilities or the healthcare or REIT sectors. And because these low volatility strategies do tend to have a bias towards these sectors, and you may end up allocating a bigger portion of your portfolio to these sectors. So I think it's very important when you're investing in low vol strategies to be mindful of what kind of constraints there are within the portfolio, and how are you able to mitigate this best in a portfolio. And I think a very important consideration with low vol strategies is that these are not no volatility strategies. So low volatility screen for volatility based on historical volatility. So when you look at backward looking or looking at companies that were the least volatile in the past, there's no assurance that these will be the least volatile companies going forward. So there will be equity risk present, right? So these strategies don't completely eliminate volatility. What they do is try to dampen the volatility and hopefully protect capital better in down periods or periods of market volatility than the broader market.
All right, so we just talked about some of the benefits and some of the considerations to have with low volatility funds. A natural segue would then be what sort of investor might find low volatility funds suitable for their needs, in your opinion?
Absolutely. So this is a question we get often asked a lot, is how to incorporate low volatility strategies into your portfolio. So at CI, we think that low volatility strategies can really be a core component in any portfolio, and really be an important building block. So when we take a look at the historical results and empirical results of low volatility strategies, these strategies have really provided alpha to investors' portfolio. So higher absolute and risk-adjusted returns, provided lower drawdowns in periods of market volatility. So to us, those are all signs that they can be a very important building block in investors' core portfolio. We also found these strategies to be very complementary as well. So when you take a look at investors' portfolio and say they have a portfolio of high growth stocks or investing in factors that target high beta or high growth, low volatility strategy can really complement this existing portfolio and really help more neutralize the portfolio and really add some balance to the portfolio. We found this to be very important when you're talking to clients, or if you're a client that's in the later phase of your life, especially in the decumulation phase of your life. So the importance of focusing on that downside risk is even more pronounced here, and this is where low volatility strategies can really have more appeal in this phase of your life. But again, every investor needs to assess their own specific needs and goals.
I want to revisit the idea that low volatility stocks have historically delivered greater absolute and risk adjusted returns than the broader market. In other words, more return for less volatility. Why is that?
Yeah, great question, Aaron. So this is referred to as the low volatility anomaly, which is really the observation that low volatility stocks have had higher returns than higher volatility stocks. Obviously, this is an anomaly because it contradicts the conventional thinking that investors expect more return for taking on higher risk. There's been different reasons for why it has persisted. So the low volatility factor has been studied for over 50 years, and researchers believe there's certain behavioral biases and quantitative biases for why the low volatility anomaly has existed and why it will continue to persist going into the future as well. From a behavioral side, some reasons include the lottery effect, which is the reason that volatile stocks are similar to lottery tickets in the fact that the potential payoff is large, but the probability of actually receiving that payoff is quite low. And investors often overpay for the small chance of outperforming, where instead of the low volatility steady returns. Another reason is the overconfidence bias. Investors are generally very overconfident in their ability to forecast the future. Low volatility stocks usually have more predictable future cash flow streams, leaving to less room for overconfidence to creep in and that higher predictability of returns going forward. From a more quantitative side, another reason is really the asymmetric relationship between gains and losses. So earlier we talked about the loss and gain. So if you go back to that same mathematical example, if you have a loss of 10%, a market requires a subsequent 11.1% gain just to break even and recover the value that was initially lost. This asymmetry increases sharply as the losses increase. So if you have a 50% loss, you require a 100% gain to break even. And this is because the way because of mathematics of compounding and how interest works. So limiting the downside loss has a greater impact than participating on 100% of the gain of the market. This asymmetric relationship between gains and losses means that limiting losses during volatile markets has a much more powerful effect on long-term growth potential than achieving the same nominal positive returns. And this is really where the low volatility strategy is really powerful.
So, how have low volatility funds performed compared to the broader market during past bear markets?
So there is a lot of empirical research out there. And the S&P Dow Jones indices did a great research studying the low volatility anomaly and looking at how it had performed in different environments and regimes. And when you take a look at all of the historical bear markets or recessionary periods dating back the last 50 years, whether it's the oil crisis in 74, Black Monday, dot-com bubble, global financial crisis, what have you. In every period that was examined, the low volatility strategies outperform the broader markets anywhere between 5% and 50%, which is exactly what you would expect from a low volatility strategies. So it's comforting to know that low volatility strategies in periods when markets get tough and there is a bear market or recessionary period have really provided investors with less a lower drawdown and better risk adjusted return and absolute returns in those periods.
So we know that low volatility funds have been able to, I guess, weather bear markets relatively well in the past, but how have they performed during bull markets in the past?
Great question. And this really goes back to talking about the cyclicality of performances. So in periods of strong markets or bull markets, low volatility strategies have tended to underperform broader equity markets, which should come as no surprise to you. As these low volatility strategies will generally not own the higher volatility growth companies in the market. And according to that same research by S&P, which observed low vol index performance in both bull and bear markets, despite underperforming in bull markets, it found that low volatility indices captured most of the upside of the S&P 500, or about 70% of it on a daily basis, but captured less of the downside, about 60% of it on a daily basis. So in each case, the upside capture was greater than the downside capture, which I think is a very important metric to examine. And the outperformance of the low volatility index during bear markets was typically greater than its underperformance during bull markets. So put another way, in strong markets, low volatility strategies will underperform. But when markets get choppy and markets get volatile and underperform, that's when low volatility strategy can really prove its mettle.
All right. So let's expand on that idea a bit. So what are some of the major economic and market factors then that might influence the performance of low volatility funds?
Sure. So when it comes to low volatility strategies, the single most important factor or determinant to performance is volatility itself, and to a lesser degree, the direction of the equity market. So generally, when volatility is higher, equity markets tend to be heading lower. And as discussed, this is when low volatility strategies outperform broader strategies, as exhibited through the relative better, higher performance and lower drawdowns. History has shown us that other factors can also impact low volatility performance. For example, looking at historical data, low volatility strategies haven't performed as well in periods of rising interest rates. So this, and we talked about this earlier, utilities and REITs generally tend to have a bias within low volatility strategies. And these sectors tend to be more rate sensitive. So when rates are going up, the price or performance of these strategies tend to go down. So low volatility strategies in periods of rising interest rates haven't historically done as well as the broader market. But again, I think this goes back to understanding the low volatility strategies and what type of sector biases or sector exposure you have in your portfolio. And when investing in any low volatility strategies, it's very important to understand the different low volatility strategies out there and the methodology and the constraints that are in place. It could, from one low volatility strategy to another, you could have a very different return experience.
All right. All right. So thanks for filling us on some of the dynamics that influence the performance of these low volatility funds. Now, one other factor that can affect returns is, well, fees, and specifically fund management fees or MERs, typically in the case of these ETF and fund products. So how would you say these fees associated with low volatility funds really compare or stack up to the industry average?
Most low volatility funds are generally index tracking funds uh, or passive in nature or track an index, and they tend to have very competitive management fees. So when you look at this global set of in the low volatility ETFs out there, management fees can range anywhere from 25 basis points to 50 basis points, really depending on the type of exposure, whether you're investing in Canadian equities, US, or global equities. So this is definitely slightly more expensive than your traditional low-cost passive ETFs. For example, tracking the S&P TXX Composite or 500, where you can get exposure for less than 10 basis points these days. But these strategies, again, based on the historical results, have, despite being slightly more expensive than that, have delivered alpha and delivered strong absolute risk-adjusted returns. And then when you compare it to some actively managed funds and ETFs out there, these strategies are significantly cheaper than those strategies. So these strategies come somewhere in between the low-cost passive solutions and the traditional fundamental active ETFs out there.
What are some of the factors that investors may want to consider when researching and ultimately deciding between low volatility funds, in your opinion?
I think this applies broadly beyond just low volatility strategies. So at CI, whenever we're talking about how to evaluate an ETF and how to evaluate especially an index tracking ETF, we call it the three Ps. So performance, process, and price. Some of the things that you want to really look at is how is the investor getting exposure to the volatility factor, and how are you defining low volatility. We talked about some of the metrics earlier, talking about beta, standard deviation. There's different ways of doing it. So, for example, at CI, our low volatility ETF that we recently launched, we look at a concept called minimum downside volatility. And what that means is it's based on this concept that volatility is price movement on the up and down. But as an investor, we can still make volatility when the price is moving up. It's really when the price is moving downwards that we want to mitigate. So the strategy explicitly seeks to mitigate downside volatility. So that's one way of defining volatility, and that's the approach that we have taken. Some other things you want to be mindful of with any index-based product is how often are you rebalancing within the portfolio. For example, the more often you rebalance within the portfolio, the more often you're getting that factor purity, but you're also increasing trading costs within the portfolio itself. So it's really a balance between factor purity and turnover costs within the portfolio. And we talked on this concept a lot as well, is really what type of constraints are within the portfolio, both from a sector perspective and geographic perspective out there. Some strategies that are totally unconstrained will give you exposure, the most pure exposure to the least volatile companies. But this can also lead to instances when you have certain sector biases and certain overweights in certain sectors, whether it's a high utilities or high REITs allocation. At CI, what we tend to do is we tend to have a cap on certain sectors, which we think can overcome certain concentration risk within a portfolio. The other two is performance. So it's important whenever you're looking at any strategy or any low volatility strategy is to take a look at historical performance. And we all know historical performance doesn't necessarily mean forward-looking performance, but it's an important indicator of how the strategy does, and does it measure up to what you expect of it, right? So especially in periods of high volatility, does this strategy have lower drawdowns than the broader market? How does it perform in periods of stronger growth market? A lot of the questions that you ask, Those are important considerations to look at whenever you're analyzing any sort of ETF or fund. And then the last thing is price. So you talked about management fee. That's obviously a very important consideration when you're looking at any ETF, but it's also additional fees to look at, such as trading expense ratio, right? Like I mentioned, if you have a strategy that rebalances more, you do run the risk of having a higher trading cost within the portfolio as well. And it's also important to look at various other aspects like bid ask spread as well. If you have a strategy that might invest in certain emerging market companies within the low vol portfolio, that could potentially lead to a larger bid ask spread and essentially make the whole cost of ETF ownership higher.
All right, Nirujan, and I'm guessing for most of our investors who probably may not be aware, this information is probably already available through the fund facts, through, I guess, your website or any other fund's website.
Exactly. Most of the information we talked about today will be on the ETF facts, and most fund providers will have additional information on their website talking about the index methodology in more detail that investors can easily access.
All right. Okay, Nirjan, we're going to leave our conversation there. Thank you so much for explaining how low volatility funds work and how they might help investors ride out turbulent times. Now, before we go, I want to hop into WebBroker and show our viewers how they can get started with their research into low volatility funds.
All right, once you've stepped into Web Broker, we're going to begin our search for low volatility funds by clicking on the Research tab up here. Then under the Tools column, a third from the bottom, we're going to head over to our Screeners tool. So now most low volatility funds are going to be mutual based or ETF. We're actually going to focus on just the ETF side of the fund. So we're going to load up our ETF screener tool here, and we're going to go ahead and create a custom screen to begin with. Now we're going to select a few criteria to start with, and what we wanted to do was actually go and add fund category. Now, since low volatility funds are equity based funds, we're going to choose those categories that are equity based and keep it broad strokes for now. So under Canadian, we're going to choose Canadian equity to begin with, and then we're going to choose perhaps a global one. So these are all alphabetically organized. So we just go down the list and chose our global equity. And then we'll finally also add our, there we go. And we'll finally add our US equity one as well here, which should be close to the bottom here. So that's going to cover the kind of spectrum that we want to be able to really capture most of the low volatility funds that we're looking for. And there we go for US equity. So now what we're going to do is we're actually going to go to this category that's under the rating as a risk, because these are going to be really the hallmarks of these ETF funds that we want to capture. And we're going to start by using standard deviation as one of our criteria. Now, standard deviation is really something that measures volatility for us. So volatility, remember, is represents how large an asset's price swings around the mean price. And so there are several ways to measure volatility. That could include beta coefficient, but perhaps the most common way to do it is through standard deviation. And so, as the name suggests, we're looking for low volatility. So we want the lowest standard deviation when we're doing our screeners over here. Now, from here, we're actually going to go ahead and add beta. Now, beta is alpha and beta kind of go hand in hand. These are standard calculations that are used to evaluate an investment portfolio's return on a risk-adjusted basis. We're going to add beta. And for beta, again, we're going to look for the lowest beta in terms of how sensitive it is benchmarking to its benchmark index there. So we're going to choose that as the lowest. And then going to alpha. Now, alpha is really a risk ratio that measures how well a security, such as a mutual fund or ETF, has performed relative to its market index. And so it is a term used to describe the investment strategy's ability to really, let's say, beat the market. In other words, its edge. And so when we add alpha, when you're looking or interpreting the alpha value, it's a return on investment and not just a result of general market movement. So when you do put in the alpha, really you want to look for above average to the highest alpha securities that we can get, keeping these in mind there. So once you have that, you do have your results populated. Now you can choose to include mutual funds. For our purpose discussion, we're not going to. So we're going to disclude that, and then we're going to go ahead and view matches over here. Now, once your matches do populate, you're going to see there's a number of different funds. And again, you can play around and tinker with the different levels of that you're willing to show. So what we want to do is just run a comparison over here against some of the low vol funds. So I'm just going to pick four to do a comparison, just eyeballing what we have here. and we'll do the Invesco one here. So we can go and do comparison, and we're going to hit the compare button. Now, what I really wanted to highlight was speaking to what we were discussing about the performance. Remember, the low volatility funds are really there to help smooth that ride on market downturns. So if we go to our performance chart over here, we can see, and we're going to just look at a 1 year scale. And in a 1 year range, we can see we've had quite a turbulent 2022 that went, but really this doesn't really tell us much unless we can indicate against the broad market. So I'm going to compare it to the total broad market index, and we're going to choose the total stock market 5,000 index, which really represents the market in its truest sense. And when we come down here, and we can just click off of it, we can really see that when the broad market was underperforming, it was underperforming quite a bit at some points in its low peaks. It was low troughs, I should say. It was down to just shy of 15% there. But however, you can see the low volatility funds weathered better. So it's not to say that they did not go down, but they did not underperform um, as as badly as the overall market was when it was in that downturn there. All right. But now, by the same interpretation, how were they in fact doing on a longer term basis when there was perhaps a bull market run we had? So if we look at a 3 year scale, we can see the broader market quite taking off quite a bit at a certain juncture was well over 50%, looking at the time frame. But we can see that the low vol funds, although they were performing, but they weren't able to capture as much of the outperformance as the total market had in that retrospect there.
Well, thanks so much for sharing your perspectives, Nirujan. We chatted through quite a lot here today, unpacked quite a bit, but just before we depart here, was there any final thoughts you'd like to share with our viewers?
Sure. So I think this conversation on the low volatility strategies, it's very timely, right? 2022 was a challenging year for equity markets, to say the least. There's a lot of global uncertainty. There's a lot of earnings deceleration companies are facing. So the concept of really getting defensive is really resonates right now with the investors. And low volatility strategies, like we talked about, is a great way to stay invested in the equity markets, to really not miss out on those potential days that can really be the difference between achieving your goals and not achieving your goals, but really lower your risk profile of your investment, stay invested, and really hopefully provide a smoother ride for yourself.
Yeah. And thank you again, Nurjan. Big kudos to you. And we're going to leave our conversation here. And for those in our audience, please make sure to register for our upcoming live webinars and check out our library of on demand content available through the Learning Center and on our YouTube page. I'll give it up for Nurjan one more time. And thank you again to our audience, and we'll see you all next time.